live on Facebook. It'll take just 1 second, please. Hope you're doing well. And now I am going live on Facebook. Okay. Hi everybody. Welcome to today's lesson. I'm Sami Abusaad, Director of Education at T3 Live. We're going to go ahead and get started quickly here, but Omar, I just see your comment, so I just want to say I didn't see the question. So why don't you, if you're going to be around, let me go ahead and get back to you in just a few minutes since I started the broadcast already. Okay, does that sound good? All right. So again, welcome everyone. Today's lesson is about how to share size your trades correctly every time. But there's a lot more to it than just share sizing. Stick around with me for the next few minutes. It'll be a short lesson, but really, really important. I'm going to talk about the 4 most important things that impact the bottom line. The 4 most important things that you can ever pay attention to as a trader. Before we start, as always, a standard required disclaimer to let you know that trading is risky and that whatever we discuss is for educational purposes only. While you're viewing that, while you're making sure you agree to that disclaimer, I just want to say that also if you like what you see, if you're interested, check out the links in the description below. You can trade with us for the next 30 days for about, I think, 49 bucks if you've never been a part of the room before. So check out the links in the description below at the end of once we're done here. Okay, so we're gonna go ahead and get started. First, before opening a position, we can predetermine our potential risk and reward on every trade. Without predetermining your reward to risk, you're gambling, basically. So you have to know where the stock, what your target is, otherwise you wouldn't know what the reward to risk is on the play. So your risk is the difference between your entry and your stop. Okay, so if your entry was 15 bucks and your stop was 14.80, your risk is 20 cents. If your reward zone is the difference between your target area and your entry. So if your target was 15.60 minus the entry, which is 15, that's 60 cents. So your reward would be 60 cents. Now your reward to risk is 60 cents divided by 20 cents. That's 3 to 1 reward to risk. Got it? So, okay. So I just wanted to, actually the first thing I wanted to say is I wanted to share with you is how to share size. And then we'll talk about reward to risk. We'll talk about batting averages. We'll talk about other things that are really important for you to understand. Looking at this 1 minute chart, let's just say this was a chart that you were interested in playing long. And the entry for this was at 44.18, stop at under the whole number. Let's say give it a couple cents below 44, so 43.98 or 99. And let's say your target was the prior pivot high, which is 45 bucks. Usually, just FYI, if the stock pulls back from a V pivot, then the prior high is the target. If the stock pulls back from a rounding top, then the bottom of the base would be your target. Actually, before you should think twice before taking play that comes from a rounding top or a square top. But if you wanted to take a play that came from a V top, then the top of that V is usually your target. If the trade came from or the pullback started from a rounding top or a square top, then the bottom of the base is usually the target. In this case, as we can see, it came from a V top. Okay. So here's the entry, stop, and target, just like we said. So now, how do you share size? Well, we said we have to calculate the risk, which is the difference between the entry minus the stop. So the entry was 44.18 minus 43.98. That gives us 20 cents. Now, how do you share size? It always depends on how much you're willing to risk. Somebody like Warren Buffett, on his investments, his risk is $1 billion. my risk might be $500 or $1,500 if I'm swing trading, right? Or $2,000. So somebody who's just starting out, his risk might be $50. So it depends on your shares, on what your risk is. But you take that risk that you're willing to, the risk that you're willing to take on every trade. You take that amount. It should be a steady amount divided by the stop size in pennies. That gives you the share size. That gives you the correct share size. Got it? Now, this is easy. Now, if it's a $500 risk, it's still the same stop. So 500 divided by 20 cents, in this case, 2,500 shares. Not 500 shares, 2,500 shares. And if your risk was a $1,000 risk, your share size would be 5,000 shares. Okay? So it just depends on your risk per trade and the stop size. Now, how do you calculate the reward to risk? We already talked about this. The reward is the difference between the target minus the entry. Okay? Now, the reward to risk is the difference between the reward divided by the risk, or so the difference between the target minus the entry divided by the entry minus the stop. So in this case, the entry, we already know that it was 20 cents, right? Hold on a second. So the entry was 44.18, the stop was 43.98, the target was 44.98, $1. So 44.98 minus 44.18 gives us 80 cents. Divided by 20 cents, which is the risk, gives us 4-1. So if the target is reached, you should make 4 times your risk. So if you risk $100, you should make, on paper at least, $400. So that would have been a trade with a 4-1 risk to reward, or reward to risk. 4-1 reward to risk. Okay? So far, pretty easy. Now, instead of having, I do have a 10 key like this. I find it invaluable. Just a 10 key. Some people, connect it to the computer. I don't. So it's battery operated. You can buy it. You can find it on Amazon or anywhere. I don't know where I bought it the last time. Kensington, right? It's just a keypad, basically, a 10 key, and I use it a lot. But instead of having to take this out or take out, a calculator or Excel spreadsheet to calculate your share size, you are much better off using a table with the share size pre-calculated for you based on your risk unit. Okay? So if you risk $1,000 per trade, and the stop, which is the difference between the entry minus the stop price, the entry price minus the stop price, the stop was only 5 cents, then you would take 20,000 shares. Now keep in mind, you have to always factor in slippage and spread. If you were trading Sprint, let's say, I traded Sprint today, a little bit, okay? If you're trading Sprint, it has no slippage. I mean, I wouldn't expect to get any slippage. It does millions of shares a day. It did 44 million shares today, and it has no spread other than the 1 cent minimum between the offer and the bid. So I just take the actual size per the table. If I was trading Roku, let's say, then a little more spready, or Tesla, or any of the high flyers, then for sure I lower my share size. I use a share size that's lower than what's in the table based on the spread. So I add the spread to my stop. But 5 cents, 20,000 shares. 6 cents, 16,600. And this is rounded to the nearest 100 shares. 7 cents, 8 cents, 9 cents. And then as the stop gets bigger, you're never going to trade Tesla, let's say, with a 5 cent stop or a 10 cent stop. It's always going to be more like dollars. Like, let's say you wanted to buy it here. In this case, it's $8.45. Stop under $8.39.60. That's $5.50. Okay? So actually this goes only to 250 cents. So if it's $5.50, I would just say 5 cents. $5 would be $200. 200 shares. 5.5, 175. Just kind of estimate it. But my point was, the larger your stop, the less accurate you have to be. Okay, so when the stop is between, let's say, 23 cents to 27 cents, I still take, between 23 to 28, I still take 3,500 shares. When the stop is very, very small, 5 cents, 6 cents, 7 cents, then every penny matters. The difference between a 5-cent stop and a 6-cent stop is 4,000 shares, or 3,400. The difference between a 6-cent stop and a 7-cent stop, that's 1 cent. But when it comes to share size, it's almost 2,000 shares. So the smaller the stop, the larger the share size. But the larger the stop, the smaller the share size. So, and that's why, as you can see here, I just do a range. I don't want to have a stop based on every possible stop. I just go, initially, yes, every penny has its own share size, but then I start to create a range. So 19 or 20 cents, I still take 5,000 shares. 21 or 22 cents stop, 4,500 shares. 23, 24, 25, 26, 27, 28, still the same number. So the larger your stop, the less precise you have to be. Of course, if you want to be always precise, then you can use a calculator or a spreadsheet. But sometimes the market is moving. Your stock is moving. It's not going to wait for you to say, to $1,000 divided by 27 cents, and the trade is gone, right? It might be gone. So you have to be quick. And something like this, creating a table like this and taping it to your monitor. Here it is. I just see the tape. I just took it off my monitor. You might, I don't know if you can see it. Here it is. See it? Same exact thing that I'm showing you. Same exact thing. Okay, there it is. But I use a $500 risk, which is the next one on the table here. Let me show you. It's the next one on. So this is the same. That's what I use actually. And then because I don't like to have huge pieces of paper taped to my monitor, I already know that this column refers to the stop size, this column refers to the share size, so I don't even have the heading here. So that first row, I just don't have it on my table, but I highly, highly recommend using a table like this. I'm taping it back to my monitor because I ripped it off. Because it speeds up trading. I mean, you can calculate the share size really quickly. After a while, if you're always using the same risk unit, which is recommended that you stick with the same risk unit, then you don't really, most of the time I know already what the shares are. 15 cent stop, I know it's 3,300 shares. 20 cent stop, 2,500 shares. You kind of memorize it, okay? If it's $100 risk, same thing. So notice just the share size drops, nothing else, if it's $100 risk. All right. Any questions so far? If you have any questions and you're on social media, feel free to leave a comment in the below the video, and I'll get back to you later. If you're in the room here in the VTF, feel free to type in the question and I can answer it live. Okay, great. So questions? How much should you risk on a trade? Anybody? How much should you risk? $100, $500, $20, $1,000, $2,000. You guessed it, which is what? It depends. It depends on what you're trying to do. If you're a millionaire and you really are trying to make, like you have $1 million account and you really are trying to make let's say $100,000 by the end of the year, 10%, let's just say, or 20% or 30%, you're never going to get there if you're risking just $50 per trade or $20 per trade. So you have to know what you're trying to accomplish. You have to know also what your risk tolerance is. Some people, if they risk $50, it's the end of the world. Others, they risk $5,000, it's no big deal. Remember in Reminiscences of a Stock Operator, Jesse Livermore his initial risk was $50,000. He would routinely lose $50,000 on a trade. And that's 100 years ago. That's $50,000 back then was a lot of money. That's like $500,000 today, probably. So For him, it still was nothing. It was not nothing, but he said, you might think $50,000 is a lot, but for me, it isn't. So it just depends on your risk tolerance, on what your goal is, your account size, all of that stuff. In the beginning, even if you had a lot of money in your account, even if you had $100,000, $200,000 account, I recommend that you risk very little, like $5, $10 per trade, $20, and create a table like this with a $20 risk, $50 risk, $10 risk. Because in the beginning, you're trying to get the hang of it. You're trying to learn. You're trying to not pay attention, not let the money distract you, not get involved emotionally. And if you are risking something meaningful to you, let's say $500 is meaningful, and you start off taking $500, taking $500 per trade, risking $500 per trade, then you're gonna be already emotionally invested, which means your brain is gonna shut off. You're not gonna learn that much. So it's better to know what you're trying to do and trade accordingly. So if you're trying to learn how to trade properly, and how to, like you're just new to trading, then I recommend a very, very small risk initially. If you're not profitable trading a $10 risk, do you think you're going to make money trading a $1,000 risk? Absolutely not. Absolutely. If you're not making money trading $50 per trade, you think you're going to make money at 500? No way. The bigger your share size, also, the more likely you're not going to be able to get filled the whole share size on some of the spready stocks, or the more slippage you might take. If I'm trading just $5 per share, $5 per trade, taking $5 risk per trade, I'm always going to get filled. The stock is not. I'm not going to make the stock jump when I buy five shares or 2 shares or 10 shares. But if I'm buying 500 shares, sometimes if the stock is a little thin or spready, it might jump. So just keep that in mind, okay? So in the beginning, I recommend having a very small share size. Question: Do you use the same table for swing trading? 100%. Yeah, why not? Use the same table. Now for swing trading, it's not as necessary, because for swing trading, I put the entries in the system after the close. I don't even do swing trades during the day. I pick my trades the night before, and I submit my orders at night, actually, not even in the morning, at night. So I have all the time in the world to get the exact share size that I need. If it's 27 cents, I can just do it, 27 cents. I don't have to guesstimate. I don't have to say, between 23 to 28 cents, it's all the same share size. No, I can get the exact share size to the penny. So for swing trading, it's not as important, but for day trading, when things are moving really fast, especially at the open, you want to use a table because it speeds things up. Okay. You mean the same risk unit? No, for swing trading, for day trading, my risk unit is $500 per trade. I've been at $500 per trade for a long, long time. For swing trading, it's $2,000 per trade if it's a full risk. If it's a half risk, then it's $1,000 per trade. Okay? But it's $2,000 per trade. The more active you are, usually, the more positions that you put on at the same time, the smaller the risk. But for swing trading, for long-term trade, and also for long-term trading, your risk should be even bigger, should be even higher than for swing trading. So the larger the time frame, the less frequent that setup shows up, the more usually the more risk that you want to take per trade. Okay? All right, great. Now, another question here. Just again, stick with me until the end. There's some really good things that we're going to go over. How about this? Should you share size based on quality of play or based on your conviction? Should you share size based on the quality of the play? What do you guys think? What do you guys think? Let me know. Yes or no? Should you share based on conviction? How convinced you feel this trade is going to work out? No, just oh, not at all. Don't do it. Don't take the trade at all if it's a low quality setup. Okay, anybody else wanna, chime in here? Feel free. Yes, I think so, Beverly says. Okay, anybody else? Okay, my friends, just listen to me here. If let's say Tesla, we were talking about Tesla earlier. If I wanted to take this play, just hear me out. Usually, if you take a play with a pullback, what's your target? The prior high, right? Up here, which it actually got to. Remember we said earlier, if it's a V pivot, the prior high is the target. Okay. If I took my normal risk on it, $500 per trade, or if it's a swing trade, this is a 15-minute chart, so it would have been a day trade. Would I have been able to stick with it until it got to the real target at the high if I took 500? Maybe, probably, sure. It didn't do anything wrong. It didn't crash. It didn't. But if I took $5,000 in risk on this, would I ever have been able to stick with it when it started to come in? Would I have been able to stick with it knowing that I had $5,000 at risk? Anybody? Well, I can answer that question for you. Absolutely not. I would have probably gotten out right here. So this is the thing, is if you share size according to your conviction or the quality of the play, you will not be able to manage them properly. The ones with the big size, as soon as they start to come in, you get out because you have a lot on the line, a lot of money on the line. The ones that you undersize, you might just not even pay attention to, ignore. It is better in general, in the long run, to share size the same way regardless of the setup, regardless of the quality of the play. And you might say, what about bad plays? Well, you shouldn't be in bad plays to begin with. Does that make sense? So if it's not a good high quality play, then don't take it. If it's a high quality play, then take it with the same share size. Because again, if you oversize it, you will not be there to exit when it reaches target. You will be long gone. You would have exited right here. Okay, probably. If not right here, for sure right here. Okay? But it's not just that. It's actually a double whammy. Because when you get in right here and it immediately comes in and you're oversized, how much do you lose? You lose on the entire position. So if the play works, so get this is really, really important. If the play works, most of the time they don't go up in a straight line like this. They go up and down, and you're oversized. You will not be in it to get out of it at target. You'll be long gone way before. And if the play fails right away, so let's say you took it here on the SPY setup and it immediately came in, guess what? You're going to take a stop on the entire share size. Does that make sense? So if it works, when it works, you will get out. You won't be in it to take advantage of that big move. Or if you're in it, you'll have very small size left, so you'll get out. You'll make money on small share size or no share size at all, or zero size at all at the top. And when it fails, you will lose on the entire position. Does that make sense? So therefore, you should not share size based on conviction or quality. There are exceptions. What if the play did not involve any management? What if the play was, you get in it here at the close here today, and then the next day you get out at the open? No management at all. Then maybe you can do it based on conviction. Does that make sense? But if you're trying to do a day trade and you're not expecting it to get right to target, and you expect to manage it actually to live through pullbacks, and because sometimes they pull back and then they come all the way back down. If you're thinking I have to manage it, then if you're oversized, you will not know how to manage it. You will not be able to manage it properly. Okay? So I hope that makes sense. I hope that makes sense. Sometimes I might oversize a play. Okay, I might, but only if I'm scalping, like I'm in and out. It doesn't involve management. If I'm trying to manage it, then I won't oversize it because I know myself. I won't be able to manage it properly because I'll be thinking about the money all the time. Oh, I got too much on the line. I'm risking too much. Starts to go against me. I immediately get out, and I end up getting out of a winning trade oftentimes. So if I'm scalping, if I'm just in and out quickly, then sure, no problem. You can oversize it. If you're getting in at the close and you're thinking, okay, I'm getting out the next day at the open, it doesn't involve any management on your part, sure, you can do it based on conviction. But don't forget, you're supposed to only take high quality plays. So if you don't have high conviction, strong conviction, you're not supposed to be in the play to begin with. Does that make sense? You're not supposed to be in the play to begin with. So this is a tricky thing that I see a lot of people get wrong, including a lot of educators, unfortunately. You're not supposed to share size based on conviction. You're supposed to share size properly using the same risk unit for every trade. Some trades, swing trades, day trades, of course that involves, the day trades, I don't risk as much as the swing trades. That's fine. Or as the long-term trades, I risk more. No problem. But for example, this one, I have a $2,000 risk on T and DM. I have a few, long-term plays on T and DM is one of them. That's a $2,000 risk. I have NVTA actually is a $1,000 risk because it never allowed me, I never was able to add to it. But that's, usually long-term plays I do more risk. ADNT is a long-term play, $2,000 risk. The swing plays, just $1,000 risk. Got it? For me. So just so you know, it depends also on what time frame, what you're trying to do. All right, questions. Is it okay to take a few shares less if you're not super sure about it? Look, I don't want you to think that I'm super sure about every trade that I take. But I just look at the trade and I say on a scale of 1 to 10, with 10 being the best, 1 being the worst, where does it fall? Is it a 7? Is it between 7 to 10? I usually take it. Between anything less than that, then no. So are there plays where I feel really, really sure about? Yes. Are there plays, the 7s, the 8s, where I feel a little less sure about? Yes, as well. But it is better, trust me on this, it's better to be steady and share size correctly, properly, the same way, the same size, all the time. I don't mean the same size like 100 shares for every trade. No, I just mean the same risk amount per trade. It's better to just stick with that and not alternate too much because it'll create a problem for you. If you undersize it and it works, you'll feel a little guilty, you'll feel something. If you oversize it and it fails, you'll feel bad. We're trying to get away from our feelings here. As traders, we're trying to be as mechanical as possible. So when you go out of your way to undersize a play, to oversize a play, you're basically now involving your ego. Your ego's on the line. If the play fails, or you see what I mean? Or if it works, but you're undersized. So it's better to just share size the same way, take the same risk per trade, and not mess with it based on conviction. All right. I think I made a pretty strong argument. Feel free to say, okay, I listened to what you had to say, but I disagree. No problem with me. But I just wanted to share with you my point of view. All right. Okay. Let's see. Are there links to documents outlining risk and share sizing? What is it exactly that you're thinking about, John? Like something like this? A table like this in Excel? If that's what you're looking for, send me an email. I'll send it to you. Okay? No problem. If that's what you're thinking about. But this is something in Excel, I think everybody should learn a little bit Excel because it's such a useful program for a lot of things, especially for tracking your trades and just calculating stuff. But again, it's very simple. But if you need it, I'm happy to share it with you. All right, great. Okay, so we talked about how much you should risk per trade. Should you share size based on conviction? We talked about that. If it doesn't involve management, then you can you can oversize if you want, but then don't forget, it's gonna hurt. It's gonna involve your ego and your emotions if it goes against you and you've oversized it. So most of the time, you really want to size the same way. Now, what's a good reward to risk ratio? Anybody? What's a good reward to risk ratio? What do you think? Good reward to risk. 2 to 1, 3 to 1. We talked about reward to risk, didn't we? At least 2 to 1. Anything about 1 to 1, Jay is saying 2 to 1 and 1 to 1. Well, which is it? Is it 2 to 1, 1 to 1? Okay. Not a problem. Okay, very good. I'm gonna come back to this question in just a few minutes, okay? It's a really, really important question, but I'll come back to it in just a few minutes. What's a good batting average? What's a good batting average? Everybody. What's a batting average? Is your hit rate. How well you bat in baseball, right? Your batting average. How often you connect. 65 to 75%. Anybody else? What's a good batting average? Is 50% a good batting average? Is 60% a good batting average? Bill is saying 70%. Anybody else? Is 40% a good batting average? Now, Ant is qualifying it 50% if you're only doing 2 to 1. If you're getting 2 to 1 reward to risk on your trades, then 50% is good. That's a pretty interesting answer. Okay, good. We're going to come back to this in a minute too. The only 4 things that matter in trading. I'm telling you the absolute truth. These are the only 4 things that impact the bottom line. Let me show you what they are. 1 is reward to risk. Your average reward to risk. Most people refer to it as your Sharpe ratio. Your Sharpe ratio is the average winner divided by the average loser. See this? Sharpe ratio formula is you take your average winner divided by the average loser. Today I didn't do much, so I don't know what I did, but I didn't do much. This is my P&L in sterling. Okay, so this is, okay, I can't divide because my average loser is 0. So, okay, but I was going to just take the average winner, which would have been 548 plus 116 plus 53 divided by 3. The average winner would be 239 divided by the average loser. In this case I didn't have any losers, so it wouldn't work in this case. In this case it wouldn't work. But the average winner, the formula for it is the total gains divided by the total number of winning trades. Makes sense. Total gains divided by the total number of winning trades. The average loss formula is the total losses, dollar amount, divided by the total number of trades. Does that make sense? So like what's today? Today is the 18th. The last trading day was the 17th was a holiday. So the last trading day was the 14th. The 14th, is that right? Okay, here it is, the 14th. I'm looking for my P&L. I couldn't find it. Here's the 14th. We can do it on this. But that's a lot of trades, so it's going to take me a while. So the average winner in this case, 213 plus 274 plus 406 plus 512 plus 533 plus 84. Okay, that's 2,041 divided by 1, 2, 3, 4, 5, 6 divided by 6. My average winner was $340. My average loser, I only had 1, 200. So my reward to risk was 340 divided by 199 was 1.7. That's my Sharpe ratio actually. Or, again, your average reward to risk basically is, in this case, the net was 1.7. Okay, that's on the 14th. And then we can look at other days as well. But okay, we'll just, that's enough. I think you got the formula. Okay. So the only four things that matter. First, your reward to risk, or again, as is often known as the Sharpe Ratio. That's your reward. That's the first thing that matters in trading. The second thing is your batting average. What's your batting average? Your batting average is the number of winning, the formula for it is the number of winning trades divided by the total number of trades. So, in this case, if let's just say this was a $60 loss, or just a loss, was a $500 loss, doesn't matter. It would be, again, the number of winning trades divided by the total number of trades. It'd be 3 divided by 4, or 75% batting average. What was the other day, last day, what was it, the 14th we said? The 14th. The batting average would have been, for me, it would be 1, 2, 3, 4, 5, 6, 7 trades. So you take 6 divided by 7, or 86% batting average. Does that make sense? So that's the formula for the batting average. So the second thing that matters in trading, first thing is Sharpe Ratio, second thing is batting average, or your hit rate. The third thing is your frequency of trades, how many trades you take. If you're making money, let's just say you're making money like this, or you're making money, that's not a lot, I'm not trying to show off here, I just want you to know. Or you're making money like this. The more trades you take based on these numbers, the better off you are. However, how many trades can one find per day? Like, if I can find 100 of these, sure, I'll take all 100. But most of the time, I can't find 100 trades per day. I might find 5, 6, 7. So the more you can find, if you have a positive expectancy, which is the multiplication of the Sharpe times the batting average, is your expectancy. If you have a positive expectancy, the higher the number, the better it is. The more you can find, the more trades you can find, the better, the more money you're going to make. Because obviously your trades make money. So the frequency of your trades, how many trades you take per day, per week, per month, the more the better. And lastly is your risk per trade. You might have the best numbers ever. You might have a Sharpe Ratio of 10 to 1. Meaning when you make money, you make 10 times as much as when you lose. Okay? You might have a batting average of 90% batting average. You lose only 10% of the time. You might find 20 trades per day, but if you risk $5 per trade, you're still not going to make much money. Does that make sense? So your risk per trade, or your share size, is important. Okay, it's important. Those are the only four things that matter. What about commissions? Well, commissions for the most part right now is a moot point because it's zero almost everywhere. So what about what about other things, like maybe your office expense, my office expense? Sure, it will affect the bottom line, but I'm not going to talk about that. I'm not going to talk about your electric bill, right? I'm not going to talk about how much your monitors or your computer costs per year or whatever. I'm talking about the things that impact us as traders. The Sharpe Ratio, the batting average, the frequency of your trades, and the risk per trade. Let me show you what I mean. For simplicity, let's say somebody has a Sharpe Ratio of 2.0, meaning, what's that mean? Sharpe Ratio of 2.0. It means when he wins, he makes twice as much as he loses. So if he makes $1,000 on average, it means he loses $500. If he makes $10,000 per trade on average, it means he loses $5,000 on average when he loses. So it's 2.0, so that's double. The winners are twice as big as the losers. Batting average of 50%, meaning he's right only half the time. Number of trades per day is 6 per trade, and then risk per trade is 100. He takes 100. Let's take a look at what that trader with those ratios can expect to make. Again, 6 trades per day, $100 per trade, Sharpe Ratio of 2.0, and a batting average of 50%. 6 trades per day, that means 3 wins, 3 losses. Why? Because his batting average is 50%. Got it? Per trade, we said that his Sharpe Ratio is 2.0, so the winners make twice as much as the losses. So 2 to 1. 2 to 1. So his subtotal is, or the calculation is 3 times 2 is 6. 3 times minus 1 is minus 3. The subtotal is 3 what? What's that mean, 3? He makes 3 what? 3 R's, or risk units, per day, which means $300 because his risk is $100 per trade. Does that make sense? And then per week times 5, that's $1,500. Per month, that's $6,000. Per year, that's $72,000 per year. Got it? So assuming 6 trades per day, $100 per trade, 2.0 Sharpe ratio, and 50% batting average. Let's see what happens when the number of trades goes from 6 to 4. Guess what? That's a 1/3 drop in the number of trades. And look at the P&L too, 1/3. It went from 72 to 48. So 4 trades, let me correct that, 4 trades per day, 2 wins, 2 losses. Per trade, the winners make twice as much as the losers. So the subtotal is 2 R's per day, $200 per day, $1,000 per week, $4,000 per month, 48 per year. So notice from 6 to 4, huge difference. Let's say the trader actually risks instead of $100, $200. Obviously, I don't need to go through the math. Instead of $100, $200. So the ratios are all the same, but now he risks double, twice as much. His P&L is going to be twice as big also, from 72 to 144. Does that make sense? You see that little difference? Somebody that risks 100 versus 200, that's double, and then it's going to affect the bottom line on a 1-to-1 ratio also, 1-to-1 ratio. Let's say that person is Sharpe ratio is not 2.0, it's 1.5. So when he makes money, on average, he makes 1.5 times, the winners are 1.5 times the losses. So his subtotal is going to be 1.5 R's, risk units, times $100, that's $150 per day. Times 5, that's $750 per week, $3,000 per month, and $36,000 per year. So notice the Sharpe went from 2.0 to 1.5 to 1.5, and look at this. Look at the drop from 72 to 36, 50% cut. So the Sharpe ratio compared to the bottom line, it has an exponential relationship. For every quarter point difference or 25% difference, you get 50% difference in the P&L. Does that make sense? That's the Sharpe. The batting average, let's say his batting is not 40%, it's not 50%, it's 60%. It goes up by, it's not 10, it goes up 10%, but it goes up from 50 to 60, so 10 divided by 5. So it goes up actually, it goes up 20%. Well, his P&L almost doubles. If it went up 25%, it would have doubled. So it's 20%, almost doubled, not quite doubled. I mean, it's not quite, 144 would have been double. Does that make sense? So back to that question that I asked you earlier. What was the question? What's a good Sharpe ratio? I don't know where it is. What's a good Sharpe ratio? Again, I don't know where it is. It's one of those slides. What's a good batting average, everybody? What's a good Sharpe ratio? What's a good batting average? What should you shoot for? 2-to-1? 3-to-1? What should your batting average be? 90%? 50%? 30%? What should it be? What's the answer, everybody? I'm going to wait for you to answer here. What's the answer, everybody? I'm waiting to get an answer, hoping to get an answer. What's the correct answer? Help me out here. What's the correct answer? It depends. It depends. Okay, it depends. Obviously, the higher the better. But the problem with the higher the better is, you know, like let's say I can make my batting average really high, 90%. But that means, but will I be able to find 6 trades per day? I find 6.77, so almost 7 trades per day. Okay, is what I take. Can I find 6 trades per day if I want my batting average to be 90%? No, I might be able to find 1. Okay? Does that make sense? So, okay, so I can go to 90, let's just say I can go to 90% and find half a trade per day or 1 trade per day. Well, do the math. You're not going to be better off. Does that make sense? Do the math, you're probably not going to be better off. Or let's say I can manipulate, let's say what if I want the Sharpe ratio to be 10 to 1? Can I make it 10 to 1? Of course. I take trades and I only exit if I get 10 times my risk. Everything else, I let it stop out. I let it stop out or reach 10 Rs. And I never exit in between. Will I eventually get 10 to 1? Yes, I will. But in the meantime, I will have stopped out on a lot of trades which will hurt my batting average. The point is, you can emphasize one at the expense of the other. The art and the science also of this is to find a balance, is to have a batting average and a Sharpe ratio that's not, we would like them to be as big as high as possible, but you don't want it to be at the expense of something else. Does that make sense, everybody? So you want to find a balance so that you're not compromising by insisting on having a really high Sharpe ratio. You're probably going to have your batting average is going to suffer, and your number of trades per day, or by insisting on having a really high batting average, you might not find 1 trade a day or 1 trade a week. So that's the thing. The trick is to find that balance where you're not sacrificing one or you're emphasizing one at the expense of the other. That's the trick. Now, how long have I been talking about this lesson here? How long? I don't know, 30 minutes, 45 minutes? This is probably the single most important lesson you can actually really grok. You know what it means to grok something? I don't even know if it's a real word or not. But when you grok something, it's like when you know it with your whole being. You don't just understand it theoretically, conceptually. You know it with every cell of your body. I can describe to you what an orange tastes like. Oh, it's a little sweet like a melon, a little sour like a lemon. But the moment you take a bite out of that orange, it's a completely different story. You know now exactly what I mean, or what an orange tastes like. It's the same here. I've gone over it, and I spent, let's say, 45 minutes, an hour, I don't know how long, going over it. But if you don't really for sure understand it, it means you need to spend more time. Because to me, this is one of the most important things that one should understand as a trader. Most important thing that you can understand as a trader, it should be the most important thing, because it's the only 4 things that matter. It's the only 4 things that matter in trading. Okay? All right. Let's see. So Sharpe ratio is exponential, so maybe it's more important. They're all important. Again, it's all about finding the balance. But yeah, Sharpe ratio is much harder to manipulate than some of the other things. Like Sharpe ratio depends on your management, by the way. Is not just the management. What determines your Sharpe ratio? It's your target minus your entry. So your target picking ability. So you need to pick trades that have good targets, big targets, and your ability to manage those trades until they get to target. So that's not that easy. So you need to be good at reading charts, because how do you know whether a trade is going to get to, do we have a chart here that I can show you? Like this one, let's just say this one. I just happen to have it on. How do you know whether the target is going to be here? Let's say you took this buy setup right here, or up here. So you need to be able to know the charts really well. And then the other thing is, how do you manage it to stick with it? We saw Tesla. I had the Tesla on a chart by accident. I didn't really, or I just typed it in by accident, but it did have a setup, I noticed here. So you have to be able to manage it till you get to target. If you don't know how to manage it, you're not going to have the Sharpe ratio. Does that make sense? So it depends on the quality of the plays that you pick. It also, to tell you the truth, it also depends on the market environment. Sometimes the market environment, look guys, what am I doing here? It's all small. nothing over 500. See it? And sometimes I have $5,000 trades. I have more. Why? It depends on the market environment. Right now the market gaps and then doesn't move, and we get a blip when there's some news or some tweet or something. You know what I mean? So right now, small winners. How about today? Nothing. Small winners also. The biggest was 548. And sometimes when the market is has more momentum, more fluidity, moving nicely up and down, that's a lot, that's when you can look to make the big bucks. Okay, so it also depends on the market. I can't discount the market environment at all. All right. Okay, well, my friends, I hope you enjoyed today's workshop, today's discussion. Notice I'm not trying to show off here or anything, but notice I talk about concrete things. I don't talk about mumbo jumbo stuff that doesn't, hocus pocus, that doesn't really teach you anything. This is concrete stuff that I think if you put it to heart, you will benefit greatly from. So I really do hope that you found benefit in today's video. And if you did, be sure to hit the like button. I would appreciate it. If you'd like to trade with me, be sure to check out the links in the description. You can actually try the room for 30 days for just 49 bucks. Or if you have questions, feel free to send an email to info@t3live.com. info@t3live.com. At any rate, I hope again you found benefit in today's video, and thank you so much for sticking around. I'm Sami Abusaad, Director of Education at T3 Live. Good trading, everybody. Take care.